Good morning, everybody. Hey, welcome to Tuesday, April 6th. I hope that you had a great Easter weekend and holiday and a blessed time with your family and friends. Hey, we got to spend time with family and really and truly enjoyed time with Natalie, our granddaughter, and Maggie and Ryan, and just had a good time. And so I hope you did too. Missed you guys, though. I really did, and glad to be back with you this morning as we dive into what's happening in the marketplace. So, with that being said, Dave's up next. But before we go to Dave, let me just remind you there's only one thing that any of us can control within our portfolio, and that's how much risk you have. And from the folks I sit down with, I see majority of the time that people have more risk in their portfolio than they realize. That's why I think it's so important that you do a financial x-ray. Give us a call at 863-382-0037 to schedule your financial x-ray. We'll be back next with Dave.
5.7 Justin Bieber and DJ Snake there. I'm at 55 degrees. It's sunny in the hood. It's gorgeous. It's 8:38. You want to talk about gorgeous? The stock market yesterday. Gawa. We had basically a record set all over creation. Let's go downtown to the offices of Statler Financial Services. I think Phillip's in the office this morning. I know he's on the phone. Phillip Statler is here after a long Easter weekend. Good morning, sir. How are you?
Hey, good morning, Dave. Doing well. I'm actually at the house right now. I hadn't got out of here to the office yet, but as soon as we're done, that's where I'm heading.
Sounds like
yeah, it was a great Easter weekend. Enjoyed time with the grandbaby and family up there in Tennessee. So glad to be back in the office as we get things rocking and rolling for this quarter.
I got you. We're glad to have you back today. It was an interesting weekend and an interesting Monday. It was one of those weird days on Good Friday. The stock markets were closed, but the bond markets were open. Money's got to do something. So the investors bought the crud out of the bond market, dropped the interest rate down, and that ended up making the stock market real happy yesterday. The Dow set an intraday high, closed up 374 points. Standard & Poor's set another intraday high. It was up 58 points, and NASDAQ had a nice recovery. It's only a couple of hundred away from its closing high, up 225 points yesterday. Now we've had a full day of everything being open, and it looks like things are kind of going back to normal this morning, don't they?
Well, they do. It looks to me like we're kind of, balancing out what happened Friday, what happened Monday, as we look at the economic indicators and we look at what's happening in the marketplace. Like you said, we set some new highs, but now we're just kind of leveling off, which is a good sign. I mean, we've had a couple of really good days, and so you would expect to see some leveling off of the indexes.
Yeah, those three-digit swings in the Dow and the NASDAQ are always fun for talking heads like us to talk about. But in reality, a routine day, up 3, down 2, stuff like that's the way the stock market should work for the sake of anybody trying to engage in a financial planning over the long to mid-term.
That's right. We want to see it steadily increasing and taking a little bit of a dip every now and then to kind of get its footing and then go back up a little at a time. But as we've progressed over the last couple of years, that's not been the case. We see bigger and bigger swings, and that's just not what the markets are used to doing over time.
Absolutely. It's good for the day traders because they can make money and sometimes lose their shirts. But for those of us that hang on to stuff and expect to plan over a period of years, whether it's 1, 2, 5, or 20, it's just kind of nice looking at it from the long-term basis. Are we going up or going down in general? And by and large, over time, equities are generally going up. But that kind of changes as you plan for the near-in future as retirement gets closer, right?
Oh, that's right. It changes, as we get closer to retirement, then it becomes more and more important that we take some of those swings out of the marketplace and make sure that we have the right allocation between what do we have safe. I mean, safe meaning you can't lose your principal versus risk, which is your principal is going to float up and down depending upon what the markets are doing. that equation becomes more and more important as you get closer to retirement and then into and through retirement, Dave.
And it needs to be said, too, that you have had clients that have come in for those x-ray reports on retirement you've actually told don't have enough risk in their portfolio, because risk is also upside potential. And if they've got a few years before retirement hits, some folks need to take a little bit more risk if they want to grow.
Well, that's true. And not only just those folks that want to grow their portfolios, Dave, but even those folks that are trying to be preservationists. They're trying to keep what they have. The one thing that we know about the stock market is it helps keep up with inflation. The question is that balancing act between how much do we have in our risk portfolio and how much do we have in our safety net portfolio? And so you're right. I sit down with folks all the time that they just they're retired. They're ultra conservative, which I don't have a problem with that. That's good at that stage of your life, but they have no risk. And so I would say even the 90-year-old that has life still to live needs a little bit of risk in their portfolio. Not a lot, but a little.
I always used to have an ongoing argument with my father-in-law. He was scared to death of the stock market, and he had what little money he had in CDs. And I kept saying, for God's sake, man, you're not even keeping up with inflation, and there's not much inflation these days. Some risk is a necessity if you expect to even keep up with a modest amount of inflation.
Well, it is, Dave. Now, let me just put a little caveat in there. If you're a buy and hold person, then it may not be that good for you, because if it goes down, what I've seen in the two major bear markets that we've seen in the last 20 years is it took 4 to 6 years to get your money back. And so that's why I think you need to be tactical. The older you get, the more tactical your portfolios need to be, not just buy and hold, not just hold on to that mutual fund. That may not be the best place for you to be. Tactical has proven that it has some legs and has some ability to move in and out of the marketplace, which the older we get, the more important that becomes.
Which is kind of why your advice is very often markedly different for a 40-year-old than it is for a 55-year-old.
Absolutely. It is totally different. In every plan we build, even the two 60-year-olds standing next to each other are totally different on what they need and what they have. And so, you have to be really careful and plan specifically for that individual.
Understood. If somebody couldn't figure it out, it's kind of a slow news day. It gives us a chance to talk general purpose investment ideas and whatnot. We did have some news that came out yesterday. Nothing on the agenda this morning of any great consequence. There was an employment outlook index that I don't know where it came from, but it was up over 100 today, and that was good news in the process. Yesterday, we did get two numbers that came out that do bear on investment and futures activities. The durable goods report was out late yesterday morning, because for Easter Monday they didn't get started until late. It was a little bit of a miss, down 1.2% overall. The core was down by 0.9. That was not what they had in mind. Factory orders also off by a bit, a slight miss, down by 0.8%, and our various economists had different expectations for that one, didn't they?
They did. I saw expectations of 0.3%. I think you were telling me you had expectations of 0.5%. In any case, it was a miss and it went the wrong direction, right? So it was negative when everybody expected at least a slight positive on factory orders.
Mm-hmm. Which is kind of an interesting thought that didn't seem to affect the markets one little bit, which kind of gives us a practicum that interest rates really appear to be driving the equities markets right now. Bond yields go down, the stock market goes up, and it doesn't matter how bad the economic news out of the government happens to be at the moment.
It doesn't right now, and it's going to be interesting to see if we get more and more numbers from an economic standpoint for the first quarter of 2021. Will that have any impact, or are we just looking straight ahead? The vaccine being, 70% of the folks vaccinated, and then everybody thinks we're back to normal. Everything the gates are open and we're just moving forward. And I think that may be what we're seeing, Dave, is that's the expectation.
A little optimism is a good thing, and the optimism we got off of the employment report on Friday. I'm assuming you saw it, even though you were out on vacation. It was an absolutely marvelous employment report. The March employment jobs added numbers was almost double what the economists were expecting, and they revised both January and February up. Talking about optimism driving the market and then tempered by interest rates, we had good reason for optimism to start the week after a day off of trading on Friday.
You're right, we did, and that was, I mean, those jobs numbers, I mean, they hit it out of the park. It was a big beat, and so that was good news, and that is fuel. That fueled yesterday for sure. The question is, do we now look past that and look at jobs coming up to see, are we going to continue that? I mean, I see more and more states opening up more and more, which are all good signs for the total U.S. economy.
Yeah, understood. So basically, we take that, and then we take the interest rates having driven it. We had a party time yesterday on Wall Street. I would kind of expect the day after big gains like that to be kind of a profit-taking day, and I'm seeing kind of a mixture of green and red on my futures market. You've got the instant stuff. 45 minutes before we open, where are we going so far?
Right now we're on the index side. It's a mix. Well, I'm gonna say mixed bag. It keeps fluctuating. The Dow basically has been in the red all morning. It's down about 0.2%. The S&P 500 has been in the red most of the morning. It's down about 0.2%. The Nasdaq right now is even, but it has been both green and red, so it's fluctuating. We'll have to see how it opens up this morning. The small caps are down less than. Or just slightly above 0.1%. So everything's looking okay on the index front. You wouldn't expect much different. On the commodities front, though, we see all green. The silver's up 1.25% to a little over $25 an ounce. Gold's up a little over 0.5%, $1,738 an ounce, and crude oil is the one that we don't like to see in the green, Dave, but it's up almost 1.5% this morning, $59.52, still under 60. Hopefully we can keep it there all day today.
We could live with that very nicely. Overseas markets, mixed bag in the Asian rim, kind of responding to our day, starting the day out at 6 o'clock this morning. It was kind of one side or the other of the zero line. European markets generally heading up this morning. British markets are up by 1.25% halfway through their day. We were talking about different strategies for different times of life, Phillip, and different needs based upon what one's portfolio looks like. That takes some expertise that's separate from the family eyes. How do I find you to get that expertise?
It is, Dave. It's important, like we said earlier, that we have the right allocation between risk and safety within our portfolio. And the only way to do that is really and truly dive deep into the portfolio to find out how much risk we do currently have. To do that, give us a call at 863-382-0037 to schedule your financial x-ray. Go to our website at statlerfinancial.com. Under the events tab, we have a couple of events coming up over here the next week or two. Take an opportunity there. And then join us this weekend for the Statler Financial Radio Show, 6 a.m. and noon on Saturday, 10 a.m. Sunday morning on Highlands News Talk, 730.
All righty. Back here again tomorrow morning, same time with an up-to-the-minute look. Phillip, thank you so much. We'll catch you then, all right?
All right, man. You have a great day.
You too. Take care. It's 105.7 Light FM and Statler Financial Services. Phillip Statler.
Hey, everybody. I want to thank you again for joining us today. I hope that, it's a slow news day, but hopefully you got some good information out of the program today. Again, I want to thank you for joining us. Glad to be back in the saddle today. I hope that your week is off to a good start. Remember, there's only one thing that you can control in your portfolio, and that's how much risk you have. Give us a call and let's find out exactly how much risk you have in your portfolio. 863-382-0037. Hey guys, have a great day. I look forward to talking to you again tomorrow. Bye now.